So I would just take initial 2-3 minutes to explain what our investment philosophy is, because until you understand that what is the thought process behind any investment, nobody can really understand what in the stock lies for the future. So that's why we would like to elaborate on the process, that what we are trying to do here is we are trying to have a partnership in a franchisee characteristic businesses which are selling at attractive valuation while benefiting from an accelerated profit cycle. So the keyword here is the accelerating profit cycle. And we understand that any stocks follow the profit. So profit centricity is at the core of our investment philosophy. And that's why what we think is the most important pillars of wealth compounding is exposure to growing assets. So wherever there are certain factors at play, which could be internal or external, and these drivers are going to shape up the growth of an asset. So we rather would like to figure out the internal factors sometimes, that what is happening inside companies. So we do lots of scuttlebutt and external factors as well, that we would like to speak to the competitor most likely and try to figure out where who is making most bucks. So most of the time our stock picking happens from the ground. The case I'm going to talk about is also on the similar size, where the growth is almost waiting for to happen. And second pillar is the capital preservation, which is the classical Buffett like investing philosophy, that we would like to save our capital. And the crux lies into finding high quality businesses. So we rather look for durability in the franchise operations, like it has to be repeatable and kind of durable. So we would like to have businesses which have a kind of a cash flow, future cash flows, and at the cusp of accelerated profit cycle, where the profit going to come. So we are not like classical value investor, that we would like to have pieces of businesses which has done good in the past. Many cases the past could be checkered in the sense that there would not be any proof of numbers, but we take calls on the future quality, and for that we do lots of scuttle. But the framework lies on figuring out a company with either two things: whether they have the competitive advantage, which is defensible in most of the circumstances, and secondly, either they have to have a dominant market share, or they are the lowest cost producer of any commodity or any equipment. It could be brand, it could be anything, any services also. They should have a proprietary asset which enable them to deliver something which is out of market. So they can either defend their moat, or they can defend their market share. So these two things are very important, and that's why we would like to have companies with qualities, and with which are positioned to do well because of certain growth drivers present in the market. And our definition of investing process lies with a one important word called conviction. So we would like to define our conviction into three stages, and I am going to talk about the third one, which is today is alpha accelerator, where the thesis is right and the profit cycle is almost to be confirmed. Just before a profit cycle confirmation, we kind of try to have positions, and then we kind of maximize the allocation. So the case today I'm going to talk about is related to JNK India. But before that, standard disclaimer that this is only for educational purpose. Sadhan is not a SEBI registered investment advisor, and we are having our positions into this company, so we can be biased. So here is a company with named JNK India. Let me give you the history of this company, because we try to have a full view. We try to have a full understanding of why it started, why the company actually exists. So the existence of this company has to be understood. And the name is JNK India, and JNK has a parentage of a Korean company, which is called JNK Global. But if you go back into history, then JNK Global was actually called Dalium. So you might have heard of companies like Samsung, Hyundai, and LG. These are the Korean chaebols, and even in 1980s, they were leading EPC contractors. So in this, there were three companies: Hyundai, Samsung, and the third one was Dalium. So Dalium Engineering Limited has spun off its heating equipment unit for some reason in the name of JNK Heaters Company Limited in 1998. So this was a spun off, and they changed the name to JNK Global. In 2007, what happened in South Korea is that South Korea wanted to protect some IP. So that's why they had put some export control over processes over certain businesses like these, like EPC, high technology EPC companies, where they have put on some restriction that you cannot do this, do that. So JNK, which was a Korean company, but with a global ambition and specifically towards to do something into India, they had to set out an outfit into India. And this was not done all alone. It's not a MNC company. They just had 26% shareholding, and actually they collaborated with two ex L&T employees who are the promoter and director of this company. This JNK India was formed in 2010 with equity seed capital, you can say, from JNK Global, JNK Korea, and technocrats promoter from L&T ecosystem. So now JNK India JNK Global controls 18% stake in JNK India post IPO, and it is one of the leading pure play combustion equipment company with long relationship across 21 domestic and 8 overseas clients. And so to say, we have in India is roughly 24 companies, and out of 24 they have 21 clients, 21 of the companies as clients. So basically I'm talking about all the oil and gas majors like IOCL, HPCL, and fertilizer companies. So this company is oil and gas EPC specialist. Let's get down to the business after understanding the reason why they exist. So JNK India is a leader in thermal design, manufacturing, and installation of heating equipment for refineries, petrochemical, and fertilizer industry. So I am kind of bifurcating these three as three different subunits because these three have different product to be used, which all are being made by this company. So this company looks like an EPC company, but actually it's like a manufacturing cum services company. So they manufacture these this kind of thermal products, which I will show in the next picture. So you can relate to what they are making. So these equipments are mission critical for continuous operation, and also they are required for emission compliance in refinery, petrochemical, and fertilizer. So this emission compliance unit is an offshoot. It is not the mainstay. So the mainstay is the heating equipment, which has come from Dalium. And Dalium was a brand, and they still are a brand. In size, they are 1/5 of Samsung, but they are a big company in South Korea, and also they are present into this market. They have much bigger share into global market. So they are at least 5x bigger than JNK India in terms of heating equipment in a global market space. So they have the blessings of this parent company. That's why they are already in panel with lot more Indian companies, as I said. And also they have a understanding with their parent that wherever they are not qualified, they will work with JNK Global, and they will pay some 3% fee to JNK Global for tech services, for R&D and all. And they will kind of participate into global bids also. And they will collaborate with a Korean company. So it is a quasi MNC company from a look and feel of it. And they operate from Mundra, which is into Gujarat, and they have a fabrication capacity of 5,000 MT, and they have all the certifications, triple certification of ISO, as well as ASME, which is a very important certification under categories R, U, and S. So this company has a moat of certification, a moat of technology, brand name, thanks to their parentage, and an understanding with a bigger player than them, which is their parent, promoter themselves. So structurally, it is a very robust business. So that's the important thing to understand. And they are a niche player into a sector which has a high entry barrier due to stringent safety, thermal performance, and metallurgy requirements. So what they fabricate some equipment which are steel products and other products. They manufacture it, they kind of process it, fabricate it, and build tall structures which contains heat for a refinery and all. So also they have they are experienced player now, and with global references and process know-how. So this is a knowledge based business, and they have kind of have a good product portfolio. So the first product which we should understand is a process fired heater, which is the mainstay. So these are efficient heating solutions for various industrial applications, mainly to oil and gas. Second is reformer and cracking furnaces. So reformer and cracking are kind of a second level in terms of process fired heater. So first level you can say is the heater is a level 1, and level 2 is reformer, which is more technical and complex. And cracking furnace is an evolved version of a process fired heater, so to say. These are essential for hydrocarbon processing and energy generation. So the first one, the left hand side, what you are seeing is for refinery, and the second product is for fertilizer and petchem. So petrochemical companies like Reliance, they kind of hire these guys, and Reliance being one of their clients. So they use reformers for processing ammonia, for making ammonia, and ammonia is used into fertilizer. So whenever petchem companies have to deal with ammonia and making it fertilizer or any value add, or if they have to crack it, like cracking is a process through which they break down the crude, and so that process require cracking furnaces, which are costly items than the heaters. And third business, which is a kind of additional, is like a it's a cross selling, you can say. So they have also they develop the know-how to manage the waste gas produced during refinery process and all fertilizer processes. So they handle these waste gases, because these are kind of volatile gases. So in order to contain them in the air, they incinerate it, and it has to comply with safety standards. So again, that is also mission critical. So the one point which is common across these three product line is that these all are mission critical for oil and gas sector, and oil and gas sector is always a cash rich sector. So that is the point to be noted for as an investor. So let's understand the TAM of this business.
Happy to announce that I have launched the 6th batch of Sadhan Mentorship Program. Sadhan Mentorship Program is a structured learning program where I give more than 25 live interaction with you, where I come live on weekend with you over more than 6 months, so that you get the real feeling of a mentorship. I've done my MBA from IIM Mumbai. I'm BTech from BIT Mesra and work with industry like Tata Motors for 2 years. Before I did MBA, I learned a lot about project management and automobile industry. Then I moved on to MBA, and post MBA I worked with ICICI Bank and its project finance division. Post that I worked with L&T Infrastructure, where I learned nuances of debt market, the bond market. And I worked with Hero FinCorp and IL&FS Financial Services when the whole financial crisis was happening in 2018. So I had a very mixture of experience, and that's why my analysis is most real, because I've seen the titans collapse. So that has built the base for me to understand the market. I've been there working over last 5 years on investing and talking about how to pick multi-baggers, how to build up a portfolio. And I'm trying to build an institutional quality understanding of market to retail investors. So in this mentorship program, what I bring forth is my experience as a project manager, my experience as a structured finance professional, as a project finance professional, at a bond market participant. So my experience is not just as an equity analyst. What you get here is a whole hog, a complete view when you learn from me. So whatever I've learned in last 15-17 years, I'll be sharing in the course. The course is priced at 45,000 for 1 year, and the course would actually end before a year. It would be 6 months to 7-8 months, because the live classes will happen almost every weekend or alternate weekend. So you'll get a recorded content of around more than 100 hours. Overall, the structure is that I'll talk about initially about the foundation, then I'll teach how to do the financial analysis so that you can select the good players from the bad ones. Then I'll share my toolkit, how I do it. I have developed Excel, which will help you to do your analysis, like Sadhan Kavach, dual calculator, Sadhan ROIC shift, and all those things I share, whatever proprietary I have developed. Then once you are equipped with that, then I'll take you to the business cases. So business analysis, how to pick businesses, how to understand, deep dive into sectors, how to identify new sectors for sector rotation, let's say. Then once you develop the business analysis, the financial analysis, then I share the frameworks which I carry and which investment gurus like Charlie Munger, Phil Fisher, or Peter Lynch, Warren Buffett talks about. Those investment frameworks are shared with you so that you develop your own investment framework, and you present a case where I try to give you feedback. After that feedback, you develop your own investment framework. So that is the end game. Alongside, I also talk about the behavior finance discipline which you need to develop to keep multi-baggers roaring. If you are really passionate and really want to put efforts on weekend to learn this art, directly from me, then this course is meant for you. So if you are willing to join me in this journey of live interactive mentorship program, then you can check the link in the description. Join me in my journey.
So as I said that there are two types of heater. One is a high capex heater, which is much costlier, goes up to 200 crore, and low capex heaters, which is typically 50 crore to 75 crores. And one refinery has 12 number of low capex heaters. Reformers, which I believe is a more high margin product for this company, because in reformers very few players are there. Hardly I could figure out 3 companies in total, including small companies. So JNK is a kind of a, can be said that they have a high right to win into reformers. So reformers are costly product, 200 to 350 crores product, and cracking furnace is icing on the cake, which is used into petrochemicals, which has 350 crore per unit of cracking furnace, and they got first order of cracking furnace this year. So they are moving to high value added products now. And just to comprehend all of this in terms of financial metrics, as a thumb rule, 3.3% of the capex of a refinery and 16% of the capex of petchem project and 6% of the capex of fertilizer projects are utilized in sourcing heating equipment. And this is the only company, only bigger company. There is one French company also, Houtery, which is smaller company. So French company has a India operation which is smaller in scale. They also have all these 3 items ticked, like reformer and heater and cracking furnace. All 3 items they make. But this is one of the 3 companies which can supply to all 3 kinds of industries, being refinery, petchem, and fertilizer. So just to bring a number on the table, I did a simple mathematics here. So I just did a rough estimate of next 5 to 7 year refinery capex announced by VPCL and likes of that. So in total, like 2 lakh crore is going to be spent in 2030 or 2032. And if we multiply by 3.3%, so we get around 7,000 crore. So likewise, fertilizer is going to be a new growth area where 1.9 lakh crore are to be spent. And as we speak, Prime Minister Modi was doing the Bhumi Pujan just 1 hour back in Assam, where we are opening up a fertilizer plant. And I've witnessed many fertilizer plants are being revived because India is agricultural country and we need fertilizer plants. And fertilizers plants company has a more right to win. So future wise, I would say that all the geopolitical situations are favorable. And just TAM perspective, say if we calculate, we get a TAM of roughly 70,000 crores for next 5 to 7 years. So if we divide it by 5, so or 6, then we get around 15,000 crore of annual TAM if we take a 5 year kind of a division. And this company enjoys 25 to 27% of India market share. So out of 15,000 crore, they can get up to roughly 4,000 crores kind of TAM where they have a right to win, and it is a maximum limit. And so this number looks on the higher side, because if you see the numbers of top line and financial, you will see that this is a big leap for this company. If they maintain their tempo. Just to give you general idea of the products, so their core business is process fired heater, reformers, and cracking furnace, which are critical. Waste gas handling is the second line of business, which is just developing, and third line is renewable energy, where they are trying to build optionality as they are doing something which is not meaningful, but they are developing some capability towards renewable energy, particularly towards solar and green hydrogen. So they are a kind of already they are into oil and gas. So green hydrogen is not a very difficult thing for them to do, and they smell an opportunity into green hydrogen. So they have done some strategic investment into a company which is a joint venture with a Chemdist company. Chemdist is set out by 2 techno entrepreneurs who are IITian and they are techies. So they are bringing the IP, and these guys are going to put up around 50 crore of working capital and some 10 crore of seed funding. And they are expecting this with this their technology, which is hovering around the green hydrogen, and which are on sustainable fuel and other stuffs which are kind of ESG related businesses. these guys are doing R&D, and this company expect around 8 to 10% of revenue in coming year from this business. So they have recently acquired. So this year their consolidation will happen. So let's see how much they are making from it. But they have a good plan to make around 15 to 25% over 5 years as a revenue contribution from this line of business, which is not present as of now. But this is an optionality for us. We are not looking at it in our business main case. So, what is the secret of this company actually? Why they are doing what they are doing, and what is the framework which I initially said that they have to be the lowest cost producer of some service or some equipment. So, this company have mastered the art of modularization. So, anybody who had a background of EPC and have heard of L&T and understand L&T, then L&T, what L&T does from better than others is called modularization. Modularization. So they make modules, their OEM plant, and they kind of put it. They don't go at the project site and make those things. They make it in the in house, and they transport it there. So in forms of modules. So better modularize you are as an EPC, you are very cost competitive. So it helps. JNK India is saying that they have achieved 20% reduction in construction time, which is very important. And that is a hallmark of a EPC company. If you reduce the construction time to 20%, it saves a lot for the client and for you as well. And 15% cost saving. So these two things are are a result of modularization, which helps into on site level saving and other things. So, and delivery timelines are excellent. So that's why this company has maintained actually the DNA of L&Ts. That's why I mentioned that what is the background, and understanding these things are very important for one to create an hypothesis around numbers. So let's look at the number. And this company has done in quarter 2, they have done 184 crores, and their numbers have started bubbling up. So last Q1 was the rock bottom number. Q2 onwards, the revenue has grown by 71% YOY. EBITDA have also gone by 44% to 22 crores, and PAT is grown by 68%. And let's look at the margins. So the gross margin has been flickering, and that's why the company shares has not done well, because it's an oil and gas company, and oil and gas made the fluctuations are not there, generally not there. But this company has shown very volatile gross margin. You can see that 49, 47, 40, 55, and in last quarter, 42% of gross margin, which is very volatile, so which is not a typical case into any established industry, and even EPC, maybe this is a too volatile. So I'll explain the reason why this happened. And EBITDA margin has bottomed in Q1 to 3.4%, and now it has bounced up in Q2 to 9.3%. So that's the important thing, that this company has bounced back to its initial last year high, or you can say last year average number of 9.7 kind of EBITDA margin. So let's understand that why Q1 was the worst quarter. And the reason for margin compression was because they were involved into some legacy project, has lower margins. And there was some execution challenge because of rising raw material costs. And there are some projects were not in the stage where they would be making money. So that has impacted the profitability. And actually, what they were following was the output based accounting. So where a milestone based accounting, which is very typically even L&T does that accounting based milestone based accounting, where what you do that is just like a typical real estate project. If you have a 5 towers to be made, if you made one tower, you will book that 20% is done. So likewise, they were doing like that, but this has led to lot many uncertainties and the volatility into the gross margin and all. So they understood that this is a problem. So they have made a remedy of that. I'll speak about that. So that was the reason why Q1 was a very bad quarter for them. But Q2 may something interesting has happened, and that is they got an order from their largest order, and that led to around 1800 crore of 1850 crores of order book. For this, it was they were having just 900 to 1200 crore maximum order book. So 1200 was their peak order book. Now it is 1850. So order book by mix is still 90% coming from heating revenue, 5% from process plant, which they are trying to get into this business of process plant, and also which is a kind of a R&D based and slightly more evolved product they are doing. And flare and insulator is the waste gas handling plant. So that is 3%. So still 92% is going to come from heating revenue. And the most of the clientele is 88% into petrochemical, 9.5% is refining, and around 2% is the steel. Major projects, what they are doing is with Reliance Industries, Hindustan Petroleum, and the largest one is HPCL Bina, which has come from JNK Global. So JNK Global has got 2,600 crore order for HPCL Bina, and they have passed 1,048 crore order to this company, JNK India. So that was the synergy I'm talking about. So in lieu of this, they might have to pay them 3% on this. But I envisage that since the big package is with the parent, so another 400-500 crore of order would flow up in next couple of months or next 1-2 quarter. Because the order size is 2,600 and that's so far have distributed 1,050 crores. And with some scuttlebutt, I figure I got to know that they have distributed another 400-500 crore to other subcontractors, but still they have a leftover of around 500-600 crore, which should ideally flow to their subsidiaries, not subsidiary, but associate company technically. So the timeline of this project, which is the most important one, is to be done by February 2028. So this is like this company is having 1850 crore of order size, out of which 1000 crore is going to be delivered by 2028. So we have a strong visibility for coming quarters. So that's what I was talking when I was saying Sadhan philosophy, that accelerated profit cycle is awaiting for this company. And the key triggers being one being the accounting, which the company have understood that the problem in accounting in terms of revenue recognition was impacting their numbers. So they have changed the output method to input method, which means that they will not wait for milestones to happen. They will just say that I've spent out of 100 crore, if I've spent 50 crore, then quarter I booked 50 crore, then I will book a profit based on that. So it is not linked to milestone, but it is linked to the cost incurred. So this is a very linear kind of business model. So if you now we can make a very simplistic revenue model of this company, because basis the order book, and we try to do that. So this input method changes the game for them, for this company to be understood well by the investor community. So that is one simplification which is going to help this company get its earlier position, which during IPO time it was valued around 2,500 crore market cap. Right now it is 1,200 crore market cap company. So they have lost the sheen of market cap because of this margin compression, and because of kind of accounting ke liye, it was one of the reason why they could not deliver. Apart from the order booking, which they have gained, their order book and everything has grown. We'll talk about that. Second is the green hydrogen opportunity is basically an optionality, because as I said that they have done a JV with chemists, but also they have done one CBG project, which is compressed biogas for IOCL Faridabad, which was a pilot project. So they have developed this capability for non-petrochemical, for a slightly greener version of petchem project, of oil and gas project, with the same clients. Like IOCL also has to do some green work, so they are in sync with IOCL and ONGC and likes of that. So they are very much client centric, and they are expecting from this JV, which is the chemists JV, that they will get around 10% of revenue in FY26, and the margin would be 10 to 12%. So I'll talk about the margin. This is not a high margin for them, because they themselves have done in past around 17% kind of margin. I've seen last 8 quarters, and average was around 16-17% EBITDA margin, but right now they have done a 9% margin, and this investment will be bringing 10 to 12%. So it would not be margin accretive that much, but it will add to the top line and bottom line also, and it's a capital light entry. So they are trying to play smart with the capital investment. So the management guidance is intact with 40 to 50% in this year, and they have said that this year they will maintain 12 to 15% margin. So they will cross 12%. So right now they are in the bottom of 9%, and last quarter was around 4%. So this is a margin bouncing up from bottom. So what we try to do here is try to look at the order book and their timelines, and we kind of try to map. So the order book as on FY25 was 1,080 crore. In H1 FY26 was 1,850 crores. And we expect that another 500 crore kind of should come from the parent, or some it may come from abroad also, because they have a good clientele in Africa also. So it may come from Nigeria or other places also. So 2350 is the order book which we envisage for this year. And the growth would be roughly 68% if we take the revenue number. So in FY25 they did 476 crore. Now H1 they did 277 crore. But FY26 we expect 800 crore because of the timelines which we mentioned. So this will lead to a good PAT growth of around from 14 crore in H1 to 55 crore in complete H1 plus H2. So another 40 crore I am expecting, which H2 being heavier, and also lots of projects would come on the mill for this company. So this is the structure. So this is the last slide actually. So I'm envisaging that this is the projections. So what is our thesis into it is that this is a specialized high entry barrier niche with strong references. So references is very important because it is not like 10 players are there. Hardly there are 5, 6 players. And I will mention that there are 3 companies. One is Thermax, other is PHEL, and third is L&T, who are of a big size and who have the eligibility for big orders. And this company, thanks to their parentage, have the capability to compete with L&T and likes of Thermax and all. So this is a very high entry barrier business, and they are a specialized player, and it requires a long qualification cycle with stringent safety and regulatory requirement, which kind of creates a entry barrier for them. And their long-term track record with top-tier refiners and petchem players gives them a right to win. And JNK Global, their parent is, I checked with industry sources that they are in panel with Saudi Aramco and ADNOX, which are two biggest companies in the world. So thanks to their parentage, they have the eligibility with to compete with Middle East and all those places. And they have evolved from working with L&T, so they understand L&T DNA also. So they will be competing with them, and they are small and nimble-footed, and they have worked with all the Indian major OEMs. So I think they have a good chances over Thermax or L&T, and they are in terms of technicality, they are at par with them. So they at least their success rate would be around 30% in future bids. So that is one thing which is very looking very strong to me. Operating leverage is also there, which is going to come into play. That the margin recovery, as I said, will come because legacy projects would be over by Q2. So that are those projects are already over as per their con calls. So Q3 would be a new quarter for them where legacy projects would be over. So this is the kind of a U-turn it would take number wise. So this is suggesting a meaningful operating leverage as new higher margin projects would ramp up. And that would be again backed by the accounting shift, which I talked about already. So they are also making entry into green hydrogen, but that's an optionality. So main thesis pointer, just to summarize, is only 3 big peers like Thermax, L&T, and BHEL are there. So 30% kind of success rate can be expected. And they have already have 27% market share also. And the management is giving 40-50% growth guidance, margin of around 13 to 15%. So it would be rebound of margins from H2. And this company has a strategy of focusing first on domestic for now, but FY27 would be more about export. So this year they have got all the domestic orders, and they are positioning themselves for export capabilities. And the best part is that the in oil and gas, if you want to win 1,000 crore project, then you should have 1,000 crore of turnover. And this company is inching towards 600-700 crore of turnover. So the bigger they get, they start a virtuous cycle for themselves. So they themselves will become eligible to compete with for bigger projects where they might not need the help of their promoter like JNK Global. So that will be kind of a margin accretive, but they have understanding that they would talk to each other before bidding for any non-South Korea and non-India project. So they have a kind of a joint arrangement for bidding. So they have a bidding strategy. So they are not. So that's why I'm saying this is like a MNC company, because they have this mindset of a Korean company, which is very growth oriented, and that's why they have a right to win into export market as well. So right now we are focusing this company for a domestic, but this is a company which can do well into export when things turn around. And there are a lot many projects into Africa and Middle East. Many Korean companies like Samsung are very active in Middle East, and this company, being a Korean DNA, they have a softer relationship with all these Korean EPC.